All right, I think we'll begin now. So, very warm welcome to all our clients and investors who are joining our call on behalf of InCred Wealth. I'm Radhika. I handle customer experience and program at InCred Wealth. And today we have with us Mr. Mrinal Singh, who is the CEO and CIO at InCred Asset Management, who brings with him over 18 years of experience in investment management and equity research. He also comes with, of course, a very strong reputation in the market for his research based stock picking approach and his long term investment philosophy. Prior to his current role at InCred, Mrinal was the Deputy CIO Equities at ICICI Prudential AMC, where he was instrumental in setting up its research processes as well as designing the product strategy and managed assets of over 25,000 crores, including some of the largest flagship funds for ICICI Prudential, namely the Value Discovery Fund, which grew from 1,500 crores to 20,000 crores. He also previously worked with organizations such as Wipro and Bosch India, which I believe gives him a very cutting edge in terms of a fund manager who's also been on the factory floor. And he also has a PGDM degree in finance from SP Jain. And he's a mechanical engineer by education from Bangalore University. So a lot to that profile, Mrinal. Welcome to this call and thank you for giving us your time and what I know promises to be a very interesting, insightful 45 minutes with you. In terms of the format, we will take questions as we go. There's a Q&A box at the bottom. Mrinal will kick off with his presentation first. Thank you so much. Over to you, Mrinal.
Thank you, Radhika. Welcome, ladies and gentlemen. It's indeed a great pleasure to interact with an esteemed audience. So let me get to the point of the conversation that we have assembled for. We are talking about a very interesting thing that we are seeing in the marketplace. And what do we mean by that? We see significant things happening on the ground in the economy. And we also
Mrinal, I don't see your screen yet.
Yeah, so I'm getting there.
All right.
Can you see now?
Yes, thank you.
Okay. So we are meeting in the context of an category 3 AIF that we are launching at the InCred Asset Management. We've named it Emerging Business Fund. And we see very significant changes that are happening in the landscape at the economy level, which necessitate incremental attention as well as opportunity in terms of investing and generating returns. Now, InCred is something as a group that you guys are familiar with. So I'll save that effort of having to go through that. Most of you are in some form associated with InCred group in one form or the other. Just about me, Radhika has already mentioned, but then I have been doing equity investing for almost 2 decades. That has been something which is very close to my heart and I'm passionate about it. So before my step with InCred, I used to manage a lot of products, equity products at ICICI Prudential. Amongst the most...
Sorry, Mrinal, sorry. There's a request for your video to be on. So if you could please keep it on. Thank you.
So, the value discovery is one of the products that was very well associated with me. So I've just put across a 10-year track record of having managed that product that is in public domain. So when I left it last year, our 10-year track record was a 15% compounding that we had done year on year for almost 10 years. That was 5%, 4.5% to 5% ahead of what market had delivered in that time zone. And very often people would also like to look in terms of a calendar year track record, which is what Morningstar does. So just to summarize this, the fund had been in top 2 quartiles in 7 out of 10 years in the tenure we are talking. What is important in this is, the 10-year encompasses flat markets, rising markets, falling markets, all kinds of markets. I mean, more about that later. So just to give you a sense of the setup at the AMC level, we've got the CIO, that's me. We have 6 research associates that help me analyze investments. We've got a couple of dealers and we've got other support functions on the investment side. Now, What is it that we think is making a significant impact in the economy? And is the market recognizing it or not is something of very paramount importance when we talk about. So let me straight away go to what we think is most relevant. So what is it that we believe is happening in the economy? So you'll have to be a bit patient with me when I talk about it. So if I roll you back to 2020 January, which is when we had the corona emerge in China in particular. At that point, when China did went into lockdown or shutdown, whichever way people might like to call it, that was, if I remember right, was 20th of January 2020. So at that point, we had a situation where China is a meaningful part of every manufacturing supply chain globally. Now, be it automobile, be it pharmaceutical, microprocessor, electronics, shipping, logistics, everything. So what is also very great importance is that this is that time of the year in China where there is Chinese New Year. So when China did go into a lockdown around 20th of Jan 2020, we had a situation what in economics is called a supply shock, wherein because of China shutting down due to corona, there were two assumptions that happened. There was disruption in the global supply chain, but then because generally as a matter of practice, in run up to Chinese New Year, most businesses do pile up some inventory, couple of months. So people and businesses assume that, okay, fine, this will get over in some time and it will remain. The second assumption at that point, the global businesses thought was, this is going to be contained within China and this should be manageable. And it will last a couple of months or so in that order. But what we had by March of 2020, I think, if my memory serves me right, 23rd of March, I think by then we had most major economies in the world getting into lockdown and shutdown due to corona, and corona had without doubt spread into every large geography that we know of in the planet. Now, and by March 23rd of that year, it was known that it is everywhere, and what in economics would typically be called, it began as a supply shock, but it became a demand shock as well. So we had a situation where, demand shock and supply shock was hitting global economies. It's a death knell in terms of theoretical assimilation. We are talking about returning to Stone Age, where when the economies don't have demand, don't have supply. Now so it necessitated the global policymakers, the central bankers to step in, and we saw the Fed first to step in on March of 23rd, and they came out and said that we will flush the system with liquidity. We are in fact going to go ahead and even send checks to households. Basically, the assumption was that, okay, fine, we have a humanitarian crisis. We should not have economic crisis along with it, and let's first deal with the humanitarian crisis, and then we'll figure out what to do with the economy. Fast forward 9 months, around January of 2021, science had taken over. We had more than a couple of candidates on the vaccines on the horizon. It looked like some bit of protocols were in place to handle corona as a society. Couple of waves had gone by. It was looking, at least on the outlook side, okay, that things would finally see the behind of corona. Too early to say, but nevertheless. But interestingly, on the economy side, something very significant happened in January of 2021. There were very strong demand revival that global Western economies in particular started seeing. And at that point, what did happen is, although demand revival was very strong and robust, the supply disruption continued. And that was primarily because China continued to remain, and to this day, they actually practice a zero COVID policy, which basically makes them, shut down cities and industrial centers randomly. Even today, if you go to China, you will be quarantined for 2 weeks, if not more, if you land up there. So it became a difficult scenario for most leading corporations and businesses worldwide, wherein you had demand in a strong way coming back, but then supply wasn't consistent and it was heavily disrupted. And in my view, that is the biggest reason why we started seeing inflation. And we continue to have supply-related constraints. A lot of people claim that it is liquidity to do with inflation. I think that is one element of inflation. A large part of that is due to supply disruptions that continue to this day. We started hearing things like, containers are short, microprocessors are short, intermediates are short, all kinds of mid intermediates and raw materials were kind of short, particularly emanating from China. So we had at that point, global procurement guys scouting around for geographies and areas where they could de-risk and diversify away from China. And the obvious beneficiaries were the likes of Vietnam, Thailand, Malaysia, Philippines, Bangladesh, India, and their own areas of strength, I would say. Now, so this is what is typically called the China plus one. That's a nomenclature that is given, but it is driving very strong demand in specific sectors, and the underlying common theme in those sectors is definitely the de-risking or diversifying away of procurement from China. So in India itself, we are seeing some sectors which are meaningfully benefiting out of it. And I'll dwell upon it as we talk ahead. So interestingly, that is what is the biggest driver of economic activity that we continue to see in the economy on the manufacturing side in particular. Along with that, we have had a decade of consolidation in the Indian economy where a lot of corporates have kind of deleveraged themselves. And we are in a very interesting phase where the government also has, post the Ladakh standoff, came out with PLI, performance links incentive, particularly in 14 sectors, which is kind of reducing dependence on China in particular or imports in particular, and incentivizing production in the country. And the most conducive environment we've seen for a very long time in terms of borrowing, be it interest rates or the credit environment itself, and the resulting domestic demand that it can propel. Now, where do we think in the cycle, business cycle that we are in? If you can follow my cursor, I think we are walking out of the housing glut as we speak and moving into a zone what is called the corporate capex zone. Now, this has to be necessitated by a demand revival. And why do we think we are there? So this is the most important chart that I want your attention to. If you can notice, there are three graphs that I have put across. What we've done, we've basically split the last 20 years into bucket of 10 years each. So this is the first 10 years of the millennia, which is 2000 to 2010-11. And we had the most robust growth that we saw in that tenor in those 10 years. We had very, very strong, meaningful ramp up in terms of the revenues, the market size, the poverty alleviation targets, the household income levels, and everything, every high frequency matrix that was followed. So we have, what happened in that zone? So if you notice the blue line that we are seeing, and this corporate capex. So the capex in that zone, that era, particularly in 2003 to 11, was growing at 30% CAGR. This is a meaningful number. And why I say this is meaningful? Because it's classical economics. Again, you invest in the economy and growth follows. And where is the growth? The growth is here. So we had in the same time zone where capex or capacity expansion was galloping at 30% CAGR. We had revenues move up by 21% CAGR, and we have earnings also moving up by 21% CAGR. And that's very, very interesting because this is amongst the most sustainable, robust momentum of growth that we've seen in our economy. And a lot of things changed for good in our economy in that phase. Interestingly, the cash flow from operations, as called CFO, was at 13.5% CAGR. So basically, the corporate India was investing 2 times the cash flow. And why were they doing that? Clearly, because the demand was so strong and it made sense to actually address the demand rather than let it go. It is obviously normal business. And most businesses would like to be in this scenario where demand continues to be robust. So very strong growth numbers in those 10 years. A lot of zeros got added to a lot of figures, including the government balance sheets, including the household incomes, including the profit and revenue lines of a lot of corporates. In the meanwhile, we had a Nifty surge by 6 times in that time zone. And the manufacturing part of Nifty actually moved up by almost 9 times. Now, this is an important data. And in my assessment, in the last 25 years, we haven't seen the services actually faltering on growth. Services either grows at mid-single digit or higher double digits or mid-teens. That is the trajectory of growth that we've seen for services. The only way the Indian GDP number looks good is when manufacturing forms or joins the bandwagon of growth, which is what we saw actually at that point, which is what CAGR of CAPEX actually means. So in absence of that, we see services driving the growth momentum in India. But when manufacturing joins in, we really see very robust and fast-paced growth. That is what we are talking about. Fast forward to the next 10 years, 2011 all the way to 21, we had a situation post the GFC or the Lehman crisis, as some people like to call it. We had a demand shock in the global economy, but by the time it happened in India, it was 2010-11, where we had a situation most corporates were, had expanded capacity in a very rapid fashion, and we had businesses getting laden with debt on their books because that is how they had funded that capacity expansion, and very large capacity, very large debt, and demand collapsed because of the GFC demand shock. So we had a situation, if you look at this blue line, we are talking about a capex level of 4 trillion rupees stagnating in the economy. This is the bane of the economy in my view. But capex actually only grew at 1.9% CAGR. So in fact, if I take away reliance from this, it actually has degrown. But let's just keep it this way. So 1.9% is nothing. And if you don't invest into the economy, obviously there will be no growth. So we had lots of false starts of growth. I would say, this was a decade in my view of consolidation or a lost growth, whichever way you want to call it. So we had roughly 2% capex growth CAGR. No surprises. The revenue and earning growth was 5.5%, suboptimal for what potential this economy can do and deliver. And we periodically had spurts of growth going up and then faltering. Now, interestingly, if you notice, cash flow from operations continued to grow at 13.5%. So where all this cash was going? Because cash was generating at 13.5%, but capex was only happening at 2%. So what actually happened is, in that time zone, we had a situation where this cash was basically being utilized to return debt on their balance sheet. So we had in this last 10 years a lot of changing hand of capacity because of excess leverage, bankruptcy laws, NCLTs, surfacing and the likes. And we also had a lot of balance sheets getting deleveraged. So we now have a situation where there is capacity in the system. Balance sheets are in spick and span shape. They can potentially borrow meaningfully to expand capacity. The only jigsaw missing in the puzzle has been for last 2 years is demand. Now that demand, I think, and we believe has come basically as of now as a catalyst from China plus one, which will flow it eventually into every other segment of the economy. Please bear in mind, this is some number that I'll get back to. The bane of the economy, I think the lack of growth basically came from lack of investment, which was stagnation of capex level at 4 trillion rupees. Now this had to move up for the growth to to come across in our economy, and this can only move up when corporates start seeing demand, which is when they will kind of think of investing. That includes the government, by the way. So where do we see the baton of growth for the next 5 years, if not more? I think this will be a 10-year story in my view. The baton of growth is changing from the new age economy to the brick and mortar manufacturing part of the economy, which has always been the case in the past, where we have seen very strong growth in the Indian GDP numbers. So where is it coming from? So although China plus one is driving the private sector capex, and this is in a way, at least on the headlines, a replica of what we saw in 2003 all the way to 10. There was significant expansion in power capacity. We cannot industrialize more unless we expand power capacity, no doubt about it. So the power capacity expansion in that era, which was the first decade of the millennia, was thermal in nature. This time it is going to be renewable. It's going to be solar or something of that sort. Chemical companies will expand, no doubt about it. There is huge demand for it. The chemical companies will also invest significantly into effluent treatment plants, zero discharge mechanisms and production methods. Also, they will, they will be required to do sustainable methods of manufacturing. Discrete manufacturing will do the same. We will see a plethora of industries walking the path of capacity expansion. The headlines will remain same, but the underlines will be very, very different. Now, even automobile will expand capacity, no doubt about it. But then incremental investments will also go into electric mobility in whichever way. The future is green, there's no doubt about it. So these are the two big drivers or big pillars of the future capex, particularly from the private sector, that we are seeing. And there are very clear incentives from the society, the government, the lenders, the shareholders to drive things in that direction. No doubt this is happening, and this is going to sustain for a long period of time. Coupled with that, we have the government, which is having very robust tax collection. Even in the budget speech, the finance minister actually said we had in January end 1.4 lakh crores of GST collection for the month. We've been running more than 1.2 lakh crores for last 4-5 months. To give you a background, it used to be 3-4 years ago, 90,000 crores per month. So a very strong revenue collection the government is seeing, courtesy of the economic activity picking up. They no longer have to provide for underprivileged suffering the impact of corona in terms of higher allocation to Manrega or interest subsidy and things like those. So government will get back to significantly pumping public infrastructure, public capex, and they do best when they do that. So they will obviously prioritize things like road, rail, port, water, and the like. So they will get back to the capex mode. They have always been. In the last 10 years, we've seen significant addition into infrastructure, debottlenecking as well. Now we have amongst the highest density of highways in the world. We have seen railways invest significantly, debottlenecking of turnaround times, ports, airports, and the likes, which is now benefiting the industry. Now we are in a phase and place where we can potentially leverage that and meaningfully expand industrial and economic activity. At some point, we'll obviously start seeing there are actually signals for that in pockets too. the residential demand for housing getting back. So the secular demand of residential housing is a 20-year story, maybe more. But then we see cycles playing out in that because of lack of income visibility or job growth prospects. So once things start improving on the ground, it is no doubt that housing will itself be a very strong driver of things. Now, housing in particular, I have singled out because housing by far is the largest formal employer in the country. So if you have to move up the job generation data, housing is amongst the biggest lever that needs to be done. It also drives demand for basic materials like cement, steel, and mortgage, and likes for tiles, plywood, and so on and so forth. So this is a very, very large driver. So every time we see housing residential demand pick up, we see a lot of economic indicators moving north in a positive sense. So let's talk about why and where the economy is going to look at, or the households is going to look at. This is all IMF data on this chart. We are currently at $2,200 per capita. As per IMF, will be $3,000 by 25, $4,700 by 30. What doesn't matter is it's going to be 25 or 24 or 26, or will be 4,700, which is basically double, in 28 or 32. The real function is, we are going to double as an economy in 6 to 8 years. Now that's the important element. So the slope can be debated, but the trajectory and trend is very, very clear. So when the 3 trillion economy that we are, it doubles, it becomes 6 trillion economy. At a 6 trillion, you are adding 3 trillion more of opportunities, market size. That is very significant. Very few times in history we've seen such significant addition of economic size, and that means big business for every business that includes ours, yours, and every other goods and services who's participating in this economy. In the meanwhile, we also have 300 million. So as of now, we are 300 million households in the country. We are going to be 400 million households. So that's an addition of 30% by 7-8 years. Interestingly, we've seen quite a few economies transition themselves from a $2,000 per capita to $3,000 per capita. The most interesting part of that is, the households tend to be very predictable when they move across this per capita levels. They tend to significantly deploy their savings and expenditure towards healthier way of life, education, mobility, consumer durables, recreation, travel, communication, entertainment, and the like. So there is going to be no different at this time either. We will see Indian households spending meaningfully incremental monies in that direction, and that will be an interesting place for potential businesses as well as potential investors. So we see very good trajectory, and that's not something that we are talking about. It is something that even third party is talking about, and this foundation has already been laid for it. Why do we think that China plus one is driving demand? So look at the data now. This is data that as we speak. So the merchandise export for India, January ending, has already crossed $335 billion. So we are on track to do $400 billion of export this fiscal. This is merchandise export only. We have another $250 billion of services export. This will make it a $650 billion exporting economy. And mind you, this is an increase of more than 25% over the last couple of years. Now, please keep in mind that we are talking about a time zone where we had all kinds of disruptions due to Corona, be it, container shortages, be it logistics, be it turnaround times, be it, everything. So we have all kinds of shortages. We still have had a situation where our merchandise have galloped, exports have galloped on 25% rate. Now, interestingly, to just give you a context, if India is going to export $650 billion, give or take some this year, just to give you context, South Korea's merchandise export is $650 billion, Japan is 700, France is another 700, UK is another 600 odd. So we are talking at a scale which is in parallel to such large economies and advanced economies as well. Now, there are only 3 economies in the world which have more than $1 trillion of export. China being the largest, 3 trillion. We have Germany and US, another 1.5 trillion plus. So at this pace, even half the rate that we grow going ahead, I think we'll be $1 trillion exporter in 5 years, or maybe somewhere in that zone, if not even earlier, if we continue to do better in terms of growth rate. So I think this is a very strong data which is happening beneath our nose, something that is staring at our face, and it's a very exciting space to participate as a business owner, as a shareholder, as an economy, as an analyst, in any form that one could be. Now, where is this growth largely coming from? So if you notice, engineering goes back to back. This is a 2-year CAGR. So I'm taking the base effect away. We're talking about 20% back-to-back CAGR growth, agricultural allied products, another mid-teens, high teens. We are talking, look at textiles, back-to-back 20%, yarns, another 20%. electronic goods, iron steel, another 20% high teens. So, and the underlying in all of these is China plus one driving the current demand, but this will continue. This is just a start. But we think, this is filling up the capacity in the system. This was a leg up that was required. Post that, we will see the virtuous cycle that this economy had been waiting for getting into full motion. When we do our analysis, we find out that in the NSE 500, there are 168 companies which have increased their gross block by 50% in last 3 years. Now, these are companies which are ready to capture that demand, and there are actually 203 more companies beyond NSE 500 which have also increased their capacity by more than 50%. So these are non-financial companies I'm talking. So between these 371 companies, we see significant capabilities of potential to increase or address incremental demand upfront, and they will also drive capex. Their competitors will drive capex. The sheer scale and size of demand is very high. Just focus on this column over here. These are basic industries. So if you are cement and steel, you're talking about doubling or tripling, and if you are green in nature, ethanol, you're talking about 4 times the capacity. So this is, you can all say that this is announcements, will not happen, we can ditch it, don't bother about it. These might not happen, let's just not bother about it. But look at government, the budget has passed by. We already know government has committed to 7.5 lakh crores of capex. This is, some people say 5.5 is a like number, some people say 6.5. That doesn't matter. What really matters is 7.5 lakh crores of capex government is going to do. And when it comes to government talking about capex, they generally do that amount, give or take some. So this is, the government gets back to driving the capex, and in the public infrastructure, they obviously do in the infrastructure side, but that it still creates enough demand and job, which is what has sustained the economy for the last 10 years in particular. We also have PLI in the 14 sectors. Now, this is very significant. PLI itself is 2.2 trillion. Now, this 2.2 trillion, even if I say that only half of it or 60% of this happens, 1.2 trillion, this is not a perpetual scheme. It is a 5-year odd scheme. So let's say we divide 1.2 trillion by 5, we are talking around 250 to 300 million per year. That would mean that it's, the 4 trillion number that I talked about, the bane of the economy, almost 8 to 10% addition to that number itself comes from PLI. And beyond that, we have the private sector announcements over there, which are already saying that we'll do 5.8 trillion. These are announcements already made, 5.8 trillion of capex. PSUs have announced another 1.5 trillion. So you add that 5.8 and 1.5, you are talking about 7 odd trillion. Let's say only half of it happens, only 3.5 trillion happens. Again, over 5 years, we are adding another 700 million to the capex number. So between PLI and these announcements itself, I see the capex growth, CAGR growth could be upwards of 20% CAGR in the economy. That's very significant. And what that kind of investment in the economy, which is basically coupled by demand, does to the overall ecosystem of entire economic indicators, shareholders, governments, profits, everything, and income levels in households, we've seen in the era of 2003 to 2010. These are the large corporate announcements. These are the mid corporates announcements. These are the PSU announcements. These are renewable announcements. So between these two, I'm not even taking government into account. I'm not even taking future announcements into account. I'm not taking anything that is not on the horizon. So we see easily 20% plus growth rate in capex in the economy, which will move the needle in a very, very significant way, is what I feel. And this is something that I think market is not recognizing to its full potential. There are murmurs that people are doing and they are talking about it, but they're not putting significant attention or investor attention, I would say, in that direction. But this is going to be the driver of growth for next 5 years, maybe more, at least for 5 years. In housing is a very significant contributor to overall economic activity. 2013, back 8 years ago, when we started seeing housing glut, we had almost 30 months of inventory in the system. Now, fast forward 8-9 years, we have a situation where, income levels have gone up in households and largely the finished inventory is more or less absorbed in the system. No wonder we are seeing, a lot of people approaching even the people like yourself and us, for new project launches, and it is difficult to get finished good or finished flats and finished residential accommodation available for, builder sale of those sorts. So once this starts picking up in terms of volumes, we will see very, very high demand for, material, building materials, for mortgage, and mortgage is a great way to play it, no doubt about it as well, and, subsequently we see things on appliances, consumer durables, and the likes. And obviously what it does phenomenally good to the economy is the job generation data and the income levels. That's going to be a very significant. It will also bring a lot of the poverty alleviation targets meaningfully into the white zone. So we believe that, okay, now we have embarked upon, I think this is now there. We are no longer talking about future. We have already stepped in that direction. The virtuous cycle of CapEx, driving the ancillary goods and services demand, creating the employment generation, financing opportunities, and the cycle of consumer demand by itself. That virtuous cycle that this economy had been waiting for, I think it is started. And it is for us to recognize being early in the game has significant advantages for everybody, be it businesses, be it investors. By the time the world starts talking and recognizing that, we will always be a head start in terms of incremental returns as well as incremental advantages that come along with it. So we think we are very well placed. There is no doubt about the trajectory of the economy. This is the driver of growth for the next 5 years. This not to say that new age economies won't do well. They'll do their own stuff. That is not a problem. It will have its own trajectory. But the underdog, the under-recognized, the information arbitrage exists in this space. And we believe that it's largely going to be MSME or mid and small cap as it is called. That's primarily for two reasons. One, most leading corporations in the world have kind of become brand owners and customer owners. So what it does to them is, basically because, for example, let's say Apple is, it owns the brand, it owns the consumer, and the Apple phone maybe is manufactured in China, in Taiwan, in India, but more of it will get manufactured in India. So manufacturing has largely become a domain of MSME, and the policy catalyst has also been in that direction. So an MSME is called small and mid cap in our markets. So I think larger scale of opportunities in the value chain of manufacturing exist in the small and mid cap space, which is where I think a significant portion of our portfolio would also be invested. I'm trying to just save time by talking about the portfolio. I can take more questions as we open it up. But so I think we are very likely going to be 20 to 25 stocks, outer side 30. It is going to be a buy and hold strategy. We are going to have a high active share. By that, we mean more bottom-up stock selection that we are looking at. It is going to be mid and small cap heavy. 2/3 of the portfolio could be there. We see opportunities largely in that space. And clearly, it will be maybe a top-heavy portfolio. By that, I mean top 10 stocks could be anything between 30 to 50% of the portfolio weight. So this is an existing AIF that has completed more than 2 years at us. This was a completely different theme that mattered at that point in time. We've delivered 30% CAGR, and this is 2 years, 4 months old. And we've also delivered along with that almost 10% CAGR of alpha. Now, this is a 4-year close-ended product that we are talking. I'll just take a pause here because largely what I wanted to communicate, I've already said. Radhika, I can take questions.
Yes.
Over to you. Thank you.
Thank you so much, Mrinal. Request participants to please share their questions in the Q&A box, or they can raise their hands. I think Mr. Santosh here would like to ask a question in person, so I'll just unmute him. Mr. Santosh, you can go ahead.
Yeah, hi, Mrinal. Thank you very much. So one quick question is, I saw a slide which says that you're going to focus on the mid and small cap, right? So since a lot of these capex can happen in the large caps also, and there could be a lot of success stories, potential success stories around China plus one manufacturing and all that. So are you saying that even if you see a good large cap stock, you might not pick that, or you might still end up picking it though it's a mid and small cap fund?
So thanks, Santosh. It's a very pertinent question. When I say small and mid cap heavy, basically I'm saying that let's say 2/3 of the portfolio is likely to have a bend towards small and mid cap, but that does not mean that we'll have no large cap at all. If we find significant return potential even in a large cap stock, there are no stopping us from considering that. For example, there could be some sectors which are a domain of large cap. For example, an auto OEM. If we do consider an auto OEM, that by nature is a large business. It is never a small business. But if we do consider a textile business, that by nature is a small business. I mean, so we're not going to restrict ourselves just because we are talking small and mid cap. But the idea is to see significant return in a risk-adjusted way, and we will be across the board. But as we stand today, as the prices look across, it looks like we will be 2/3 into small and mid cap largely.
Okay, fantastic. Yeah, thank you.
Radhika, you are on mute.
Sorry, thank you, Praveen. We also had a few questions coming in earlier. One of them was, how would the rising interest rate scenario and high inflation impact the capex cycle?
So that's an excellent question. If you notice during the conversation, I said, the beginning part, actually the high inflation that the world is seeing has two significant contributors. And it's still, the jury is still out, which is a larger contributor. But one is the liquidity that got flushed into the system post the corona hitting global economies. But I think bigger than that is also the supply disruption that the world continues to see. So even today, for most of you who own businesses, you would know that there is actually supply disruption. Even now, containers are short. Even now, raw materials, particularly being sourced from China, supplies are erratic, prices go up and down. We've seen that in chemicals, we've seen that in intermediates, we've seen that in microprocessors. So a very large portion of inflation is because, demand has galloped, it has moved up, and it is more or less back to pre-COVID levels, in some cases higher, but supply hasn't coped up. So that lack of demand and supply matching is also creating inflation. So although there will be, Fed has already gone, particularly US Fed has already gone on record and said we will increase rates. I think a couple of rate hikes, at least 50 bips of rate hike, I think is more or less in the price, because it is expected. Fed has officially said that multiple times. So that is going to happen. I think that's not going to be a significant dampener. It is anyway, the rates are way too low. And if you look at the 10-year yields of GSEC and US, they already are over there, But what would also make a difference is if there is a shrinkage of balance sheet, we will see some ripples, but that's all right. The difference in particular US in real rates is very, very high. The inflation last reported printed number is 7.5%. And we're talking about interest rates in the vicinity of 1%. That's way too different, which is not the case in India. So we're talking about a very, very, different scenario. In India, we have inflation, which got reported yesterday, 6 odd. We've got risk-free in the range of another 6.8, 6.7. So we're not so bad on real interest rates. Our inflation numbers are actually lower than US. Somehow US, the supply chain disruption is way too high. Now, having said that, the theme or the idea or the investment outlook that I'm talking here is not dependent upon the growth of US economy. The underlying concept that I'm trying to put across is that the lack of demand, that uplift of demand, or basically filling up the excess capacity in the system, that China plus one. So shift of manufacturing or supply sourcing from China to India, in whichever sector we are seeing, is driving the economic activity here. Subsequently, the domestic economy will take over. So we might have a turbulent year in this calendar year. That's all right. That's okay, because we'll only get interesting prices if there's more volatility. In fact, it is a great time to invest, I would say. And I think that we are at the cusp of a turn in the market wherein, anyway, I've been saying the flag bearers of growth will change. We are talking about the future of growth, which is the names, which is the sectors, and which is the industries that I'm talking about. But we need to also, I can't overemphasize enough, we need to also be cognizant that the driver of growth for the near term and the mid term is going to be domestic, catalyzed by China plus one. It is not a function of the US interest rates. It's not a function of the US interest rates is going to back the market, not the economy on the. If US Fed comes and says we'll increase it by 200 bips tomorrow, I'm just hypothetically saying, it's not that we've seen that in the past, but if they do that, the markets will respond. The economy is not going to change track just because it happens. Look at it. When GFC hit the economy, global economies, Lehman crisis in 2008, it started showing up in India by 2011. India was growing all the way till 2009-10. The markets moved up and down in the meanwhile, but the economy was growing. And we had a new set of businesses which took the mandate of growth. So for the last 10 years, the flag bearers of growth were different. The 10 years before that, the flag bearers were different. And I think we are again at a change where the next 10 years, the flag bearer of growth are going to be different. Long answer, sorry, but I hope I have, covered all the points.
Thank you, Mrinal. We have one more hand going up, so I'll just unmute Mr. Sham. Yeah, Sham, you want to ask your question?
Hi, can you hear me?
Yes.
I can hear you, Mr. Sham.
Yeah, I think, I think it's a good presentation, actually, thanks for that. Given that, that there are, in spite of China plus one demand pool and all these things, we are entering a 2003 kind of a cycle. but still there are a lot of clouds on the horizon, like oil price, or of course the runaway inflation, and then China itself is slowing down very significantly, and you see that dry Baltics index or something, it has crashed 1/3 or something. So it's not one way. Do you think that this demand is going to stick, and some of these issues are not going to pull the whole apple cart down?
So, the reality is, Mr. Sham, and thanks for your kind words. See, when there will be shift away from China of sourcing, we will see, growth tapering down in China. I mean, that is, I don't want to say that in a public forum, but reality is, when business is going to drift away from China, we've seen that in the past. The Asian economies have largely grown that way. Their incomes have gone up and then things have moved to somewhere else. China also grew like that. Maybe it is the turn of Vietnam, Bangladesh, India, maybe Philippines and the likes. So that will happen. So that's not surprising. It actually corroborates what we are talking, China kind of. In any case, the income levels in China have gone to a level where a lot of labor intensive industries are not very economically viable. And what is shifting away is what, is more economically sensible. Like, textiles coming to India is natural. Apparel going to Bangladesh is very natural. So microprocessors going to Vietnam is also natural because there is an ecosystem, there is a critical mass of those businesses already. To your point, other points, Mr. Cham, the first point I'm missing it. You said, what was the first thing that was of concern?
What I'm saying is that will our ecosystem, the demand pull and the domestic demand picking up, and then the virtuous cycle, will it be oblivious to what is happening in US, China, or even oil because of this Ukraine and other stuff? It may be transient, but will some of this noise is going to spoil it, or how do you look at it? That's what is the.
So we will see turbulence because there are a lot of macro moving parts, particularly global. Now, which is what excites me, because I would have been more worried if we had turbulent global macro and local micro also not being in good shape. So what we have as a situation is, a turbulent global micro. We've got geopolitical concerns around Russia, Ukraine. We've got interest rates moving up. We've got liquidity getting withdrawn. But these are largely going to impact the market, as in the financial markets, let's say. But the economy has embarked. So what happened? We had this data, the data that I'm talking, Mr. Sham, we had this data even 6 months ago, and it was pointing in the same direction. We weren't sure. We thought, okay, it's on a back of bad 2020, and it's a holiday season, bullwhip effect on inventory. So, but then what is very clear now, because it is now money is going into the ground. Now there are very, even credit uptake has started in India. So this is, businesses have started having conversations and engagements on credit lines with banks. Now banks are now coming out and saying, that we are seeing credit demand. And so what is happening is, although we are not going to be oblivious, it will be naive to say that, if the world shutters will be, parting as an economy. No, that's not going to be the case. But then what is also relevant is the world might actually slow down, but our growth is going to actually pick up. Now, this is what exactly IMF is saying. So if you look at IMF global forecasts, India is amongst the very few economies, only 3 of them are actually going to see growth picking up ahead of pre-COVID levels. So IMF's forecast for next year for India is 9%, wherein the government of India forecast is 8.5%. So our growth will continue. It doesn't matter if it is 8 or 8.5 or 9. What is relevant is it is a high number, and at the size that we are talking. Oil is a significant thing. Interestingly, I had a slide on oil. Actually, for paucity of time, I skipped that. But to give you a sense, in the last 25 years, and that is all that in terms of data we have in services in particular, this is the first time we are seeing that our IT exports are able to fund our energy imports, which is largely crude. So our IT exports is going to be $150 billion this year. And our crude imports are actually, even at this elevated price, lower than $150 billion. So it is no surprise that crude or Brent is hitting $100, almost it is at 95 when people are talking 100. But it is not creating the kind of panic that it used to in the past. Why? Because we are able to fund our energy imports through our IT exports itself. Now that's a significant change that we have seen. Our merchandise exports are galloping, our IT exports are doing well. So we are able to actually import and fund our energies to grow this economy. This has never happened in the past. Every time crude used to shoot up, there used to be ripple effect on currency, economy, government balance sheet, subsidy, hue and cry. It is not the case this time. I'm not trying to say that if crude goes higher, $20, it will not impact. But as of now, where it stands, anyway, crude doesn't have a great future because it's a polluting fossil fuel. It's not going to be around maybe 25 years down the lane in terms of consumption patterns that we see now. Because I said, the green is the future. But then crude at such elevated prices, even now we are able to fund it. As an economy, we are able to fund it. We don't have to provide any subsidy. We don't have to have a current account deficit problem. So I would say that's the strength of our, export potential that has helped us import energies and continue our growth. I mean, it's an interesting phase and it's a very pertinent point, Mr. Shyam, that you picked up.
So after all, our the government's gamble to go for capex rather than consolidation probably will play out in the favor of India.
I think, government should not run a P&L. They are not supposed to. So as long as the government spends into creating infrastructure or fixed assets, rather than spending towards, what I would call, subsidies and lagras of that kind, I think that's fine because, finally look at it, what has happened in the last 10 years, government kept on making highways. So if you go to NHAI side, now the highway density of India is actually ahead of China. By that, I mean kilometers of national highways by total land mass. So we've crossed China actually. We also have done, reforms on the, the toll blocks having gone because of e-way bill. We've got, just to give you an example, the railways is the most significant reform I think we've seen in the last 10 years. What we now have, earlier, the average rate at which freight was going from Bombay to Delhi, Mumbai to Delhi was 25 kilometers an hour. Now with a dedicated freight corridor, the speed is 75 kilometers an hour and double stacked. So 3 times speed, 2 times capacity. So we have expanded dedicated freight capacity to 6 times. So we created infrastructure. Now the government continues to doing that. They now will make expressways, they'll make maybe airports, that's okay. So I would say it's not a gamble, it's a sensible thing. The market or the street or investors like me were worried before the budget that government might fall for the bait of in an election year doing, more rural dole-outs or something of that sort. But the government has wisely decided to continue investing in infrastructure in CAPEX. For them, CAPEX is infrastructure largely actually, and that's the right thing to do. So I think I would say very wise thing, very nice thing, and we will as an economy benefit out of it. I hope I've addressed your question, Mr. Shyam.
Thank you very much. Thanks for the explanation.
The next question we have in the Q&A chat is, can you give us some high-level pointers on how you do due diligence for promoters and what is the weightage given to the due diligence? I think a good question for you.
Excellent question. I mean, this is what we do as a living. Finally, the data I'm putting on the table is actually a lot of people can assimilate that data. Now, what's very important? The data that I have shared, and a lot of people can share that in some form or the other. That's not the important point, gentlemen and ladies. What is the important point is, do we have the capability to what it takes? So last 10 years, we've had a situation that, manufacturing did nothing much to excite shareholders, investors, or anybody in the markets at least. So we have a generation which has lost capability to evaluate manufacturing, small manufacturing businesses. So a lot of people don't even know what it feels like to go on a shop floor and what do they do from an investment perspective. So where, old hands like ourselves with gray hair and receding hairlines are of advantage. We have seen such things in the past. We have the capability. We have done that in the past. Now, talking about due diligence, I'll give you a simple investing mantra. And this is something that I've learned in the markets in 2 decades. A mediocre business with a superior management is far better than a great business with mediocre management. So it is the management to the point of irritating. I'll again say management, that really matters. Actually making a soap is nothing great. Unilever makes a soap, makes a shampoo, sells. It is the management that makes a difference. It is far more complex to actually make a Maruti car. It is far more complex, but it's not given the value like what a lever is. I'm just using that as an analogy. The point I'm trying to convey is, if I analyze my successes and failures of investing in the last 20 years, when I do the fishbone analysis, the clear answer that comes is assessment of management. So we do great work. I mean, I think 70% of our work will revolve around, is the management the right management? Are they interested in the benefit of minority shareholders? We are not going to take a hunch over there. We are going to see. So everybody, when the party is on, everybody talks very, very nice. We want to see how they have behaved when things were tough for them. So we go back all the way. We talk to their ex-auditors, ex-employees, ex-CFO. The best thing to evaluate a management, talk to the competitors. All competitors will actually, have very nice foul words for their competition. But even in that conversation, there'll couple of things they'll appreciate. So you talk to 4 competitors, you get a very good sense of, what is the weakness, what is the strength. So I have never, in my investing experience, I have never benefited greatly out of meeting a management of a company. So if I meet a company, I'm actually not interested in that company. I'm just talking to them, trying to explore they talk more truthfully about their competition. They talk more truthfully about things that are not directly impacting them, and then I would obviously get okay, what they are talking about themselves, but just because they say it, it's not going to. So what they have done in the past, it's very, very important. So talk to lenders, talk to competitors, talk to vendors, because how they treat their vendors, what kind of things, what is. So when people say, when I meet a management and say, we are going to double our order book, or we are going to double our business. So I will talk to their vendor and ask, order book double hua hai kya aapka? They'll say ki nahi hua. Who will double? So if you are a cement company and you think that you want to double your production, you've ordered machines. Where is the land? Have you ordered your jute bag maker or other vendors? Have you ordered the grinding material? Have you ordered the waste heat retreatment plant? Let me see. So we'll get a sense from there. So we do a lot of due diligence, and interestingly, this is a segment of the economy which largely is listed. So we have more than 3,000 stocks in the manufacturing domain listed. Actually, much more than that, but I'm saying 3,000 plus stocks, so which is large. So if we have to do textiles, for example, to invest, we don't have to buy a textile company. We can buy something else in the volume. Let's say a machine maker, a utility provider, an entity which does compressor for them, an entity which does consumables for them, variety of things. And this is what we have done so detailed in the past, a blend of experience, having seen them over the last 20 years, plus more, is of great advantage. So we know, okay, this company did that in that time, and we know what is the DNA of the management, what is that they're going to do. So just because they come and say, okay, fine, this is how we look, I mean, that's not going to go along with us. I mean, again, a long answer, sorry, but I gave you a flair of.
Thank you. No, I think that was great. I think it completely put it in perspective. The next question is, does NHPC, NTPC, PSU banks like Union Bank of India, would they qualify into your portfolio?
So very interesting question. I would say these are large businesses. We would be keen on the more greener part of government businesses, frankly. Let's say, I would say something, if I find something great on the pure play mortgage lending side, let it be PSU owned, but that's okay. We can think about it for a price. We could potentially look into a business like, you've not taken the name, but let's say Engineers India. They are consultants and architects for all kinds of engineering projects. It could be of interest to us because they get large turnkey contracts for designing manufacturing plants. So I would be a bit more wary of not so green businesses, frankly. But I'll not discriminate just because it is a PSU business. We might actually give it a lower weightage, or we might be more choosy about the price, but we will look at it.
Sure. One more question is, would this fund focus only on capital investment ideas?
So actually, let me rephrase it better. We believe, see, the fund has no strict mandate that it has to only do X. We are not calling infrastructure fund. We are actually calling it emerging business fund. As we speak today, I see great opportunity in the brick and mortar manufacturing business. So it's not only about CapEx. CapEx will drive the entire manufacturing ecosystem. So there could be a technology company which will be feeding into it. It would be of actual interest to us. So let's call it, let's keep it the emerging business, largely manufacturing oriented. CapEx will be a significant part, but then it's not only CapEx. It is manufacturing largely. Let me call it that. Radhika, I can't hear you. You're on mute.
There's one question, there's one hand that's gone up, so I'll just allow Saket, you can speak.
Yeah,
Saket?
just one question. When you were presenting, there was a slide where you had put a nice little cycle with respect to corporate recovery, capex. I just missed seeing that. Could you like send that or
Yeah, we'll share it. I mean, I ran past it. I know. Basically, I have borrowed it from Jeffries. We'll send it across if you want to have a look. If you want to discuss, maybe I could put it here. Or should I send it across? And maybe
Yeah,
you
we'll
can
send it. We'll
across.
send it across.
Yeah, yeah. And secondly, any flavor on, let's say, specific, let's say, sectors or stock specific case studies in terms of that's going to be in the fund. Maybe one or two case studies, or maybe if whatever you're at the liberty to discuss.
So I think, Mr. Saket, we could organize these one-on-one conversations for any of you to go into the details.
So just to answer, Radhika, just to answer, we've not done this in this presentation, but your RM will have additional deck whom he will come and talk to you about is basically about our success stories in the past in this fair. That is one, and also a flair without taking names of potential kind of businesses that we would like to consider, so there won't be names because it's not professional and compliance worthy to put names, but then you will have a flair, and these are 4 or 5 cases on both sides. So the RM will get in touch with you, and if required, we could do a conversation as well, Saket, in that direction.
Thanks a lot.
Another question is, I think, how do you see the post-COVID recovery progressing? I think you've already covered this. So how does the domestic demand come up? Okay, there's one question on exports. So India doing nearly 400 billion of exports this year is great news. However, what is the impact of inflation? I think you covered inflation as well, right? So yeah, we won't take that. I think there's one question on drawdowns. Would you want to take that? Can you give us?
We have 2 choices. Yeah, Praveen, you want to take that? He's our head of sales.
Yeah, so thank you, Radhika. I've already typed the answer, but we are taking 40% with the drawdown right now. So there are 2 choices, as Mrinal mentioned. Either you can invest 100% with us, or 40% now, and then whenever the team on Mrinal's thinks right time to invest, we'll call for further drawdowns. But expected within this calendar year.
There's one question, which has come saying, what is the ideal horizon for a thematic strategy like this?
Oh, interesting. So 2 things. Although it might sound like a theme, it is just a large pocket of investment opportunity that we see. So we've actually not called this fund anything like a Make in India, Build India infrastructure or anything of that sort. We still call it an emerging business fund. At this juncture, we see huge opportunity there. So in my experience, to your pertinent part in your question, in my experience, we generally think 3 years is a good time frame. The reason we've kept it 4 years is because we have a general election in the middle. So I didn't want to end it in that time zone. And 4 years give me an extra margin of safety that if things are delayed a little here and there, we will be there. So to me, it looks like we are safe with that kind of time horizon, and we should be looking forward to substantial return, which makes us greatly happy about it.
Mrinal, one more question. If you want to answer, what distinguishes this from the other manufacturing focused funds?
Excellent question. You have to look at my profile to do that. That is one, as I said in the conversation earlier, it's not about assimilating data and putting that across. First of all, have you done that in the past? How long you've done that? So you have to be 10 years plus in the system in investing world to be able to do that. Just because you think you have a theme does not mean that you are the right person to actually do that thing. So it is the question of, so most people in the policy making world, the world that is analyzing data at a macro and economic level, will know that this is a destiny now. This is the direction that economy is embarked upon. It is about how you do it, who does it, and when you do it. So we are early. Yes, we are early. There are lots of, there are so many diversified funds in the marketplace, but the returns are so very different. So, just because you have a Make in India manufacturing, Build India infrastructure fund does not mean that I'm not trying to undermine people, but then Have you done it in the past? Why is it that you have the what is called in our investing world right to win? I think we have the right to win.
That's great. Sujata, I think we've answered your question, but I'll unmute you if you have another question. Sujata?
She's not
Hello?
unmuted, Radhika.
Oh. I have actually.
Hello, yeah, am I audible, Sujata here?
Yes.
Yeah, hi
yes.
Sujata, you're audible now.
Yeah, I think the past couple of weeks I've been hearing the same thing, textiles, manufacturing shifting from China, and of course the tech play, So I was just wondering what is different about this fund and
There's
why
nothing
should I
different.
invest?
It is everything is similar, Sujata. It is India, it is manufacturing, it is not the ship, it is the captain that matters, Sujata.
Oh, I get it. Thank you.
Another question.
Radhika, you're not audible. I can't hear you if you.
Okay, now I was just checking if there are any other questions. No, we don't want to do stock specifics. Did you? No. Okay. I think we're done. I think we've covered all the questions. Any closing remarks from you, Praveen? We can't hear you, Praveen, I think.
Sorry, I think there are a couple of questions. Mrinal, we have time for a couple of questions which are in the chat box.
Yes, we can.
So one question is, will you look at defense also as a sector and opportunity to invest in this fund?
Yes. Very clearly, yes.
He has asked that what was our portfolio stand with the interest rate rising in US in last couple of months? Have we stayed invested in any? We'll avoid the stock specific, but any assumptions or expectations from any company or sector specific which has gone wrong or your assumptions have not played out in last couple of years, as per your experience? This is a very generic question.
Yeah, but a pertinent question, I would say. So, we are in our modeling, in our financial modeling, we are clearly building much higher interest rates and much higher discounting rates. So that creates higher margin of safety. In our PMSs, we obviously are, in AIFs, we are invested. The mandate is to be invested, but we are running a little higher in terms of cash, which, typically we run 2-3% cash. We are running, 7% kind of cash, but that is not to say that we are taking a view on the market. What we basically are doing is, basically creating raw material to be able to, capture opportunities as the turbulence offers. Interestingly, we have kind of reduced our exposure on a debt level, because interest rates rising, liquidity is shrinking. These are basically more pertinent to higher growth assumed companies plus higher leverage companies. So that is where we are kind of, where we have withdrawn in the last 6 months from there. And we have gone more into businesses which have more comfort on valuation along with reasonable growth assumptions and manageable and lower debt levels. So this is what we've done.
Mrinal, a question has popped up. Given you said the captain is more important in this, you have successfully managed the ICICI fund in your stint for over a decade, and you have seen all these cycles. What do you think is still pertinent, which you implemented and you learned over the last decade of your investing, which is still true today in the changing environment?
That first thing that I learned the hard way is market is God. I initially began my investing career thinking, okay, this looks like a great stock. It will double its profit. The stock will double. Actually, the profits double. The stock never doubled. It took 3 years for the stock to double. So what I realized, and I thought, okay, this is a business. Its profit is going to grow at 30%. This will be, in 3 years, it will double, but it doubled in 1 year. The profits took another 3 years to double. So the reality is, market teaches you a lot and it makes you humble. Okay. So, and the thing that I said during my conversation, that management, it is irritating to hear, but it is still the most important thing to hear. It is boring, but it is classical and it is temperamental. The science part of investing ends at research. That's a building block. The art part of investing begins after research. So talking about numbers is not investing. Talking about numbers is about the science part, the research part. How do you invest? Where do you get in? What time you move in? What kind of allocation? What kind of size? How do you blend the portfolio? See, it's like this, when you buy an individual flower, it might look good, but 10 red flowers don't look better than 2 red, 2 yellow, 2 white, 2 pink. A bouquet is a different skill. An individual rose is a different skill. Very often people miss that aspect. Creating a portfolio is about finding negative correlation. It is about creating a right kind of blend, finding the right risk at a portfolio level. These are things that really matter. So very, very seldom that these things are talked about. Sizing is a significant, in theory books, in academics, they teach you to buy. There will be a lot of literature available to buy. Okay, you do this, you buy this, you buy that, you look for mood, you look for this, you look for that. No book teaches you to sell. And there are no books and literature about, how to size. Now, this is experience. And if you notice, the common traits about most successful investors globally is about how they blend their selling and sizing. Now, which is where, so this can be a topic by itself, and I'll be very happy to talk about it, but not the topic today. But just I leave it on the table. Sizing and selling, bouquet versus individual flower. These are things that matter in investing.
I think that's broadly from our end, Mrinal. Any closing remarks you want to leave the audience?
Thank you very much, guys. I look forward to participation and join the journey. There is a lot of good time ahead for the economy. The markets will have their own course, but the economy is now ready to actually propel itself ahead. Thank you, guys. Thank you very much.
Thank you so much, Mrinal. Thank you, everybody, for joining us. Have a great day.